Alright, so let me welcome you to lesson 2, where we'll be going through the advanced approach. So basically in this chapter, which is chapter 1 of lesson 2, I'll be taking you through supply and demand. So without wasting any time, let's get right into it. Right here we have two examples, example of supply. Number 2, we have example of demand. So before I go any further, I would like to emphasize that supply and demand are divided into two parts, right? They are divided into two parts based on whether they form as a result of a reversal or a continuation. So for example, in a continuation manner, the market will have moved from here to here and then formed a consolidation and dropped again. So it's drop, base, drop, right? So base is simply consolidation, and then in a demand manner, the market will move from down here to come creating consolidation and then rise up again, right? So it's rally, base, rally. In a reversal part, let's say for example we have like a higher time frame order block or a supply, right, in a bearish manner, and then on that, when the market taps there, it will form something like a consolidation before it reverses, and then same applies as in a demand part. So now to cut the confusion, supply and demand are classified as consolidation areas. So when you mark supply and demand areas, you mark the whole consolidation. But then in the way we approach this, we actually refine it. We refine it. For example, if we marked the whole supply, means the whole consolidation, we know that when the market comes back, we can't execute from this whole consolidation because our stop loss will be huge, right? So now we identify what we identify an order block that is left before this impulse move that led to what, to breaking the structure right here, right? This is the part of the video where I'll be going through live chart examples, right? So right here we have an example of what? We have an example of demand. So you mark your whole consolidation, right? That will be what? Your demand. But then in our approach, we don't actually mark the whole consolidation or the whole demand and then we enter trades off, right? Because you can see that this will be what? A huge stop loss, right? So we actually look at what? We actually look at an impulse, an expand in price outside the consolidation. So let's say the move that broke structure out of consolidation. For example, we can see that this high was cleared. This high was cleared. This will be what? Our break of structure, right? And then we take what? We take the last order block that was created, the last bearish candlestick before impulsive move in an uptrend, right? And then in a bearish manner, we take the last bullish candlestick before an impulse, right? So right here we marked our last order block right here, and then that will be where you execute, not here at the demand, right? You refine your demand toward to the last candlestick that was responsible for and expand out of consolidation. All right, so right here we have a supply example. So this will be what? Your supply. The market consolidated right here. This is your supply, right? I'll just mark it red so that we cannot confuse the difference between supply and demand, right? So this will be your supply because we have consolidation right here. Let me just show you where the consolidation ends. The consolidation ends here. Why am I saying so? Because the market expanded right here. The market broke structure to the downside. right? Expanding out of what? Our consolidation phase. So we can actually execute where? Here. We can execute here where our supply starts. Because why? We need to refine it to get finer entries. So by saying so, you're gonna take the last bullish candlestick that was responsible for what? For breaking structure to the downside. So I'm simply saying that last bullish candlestick before this impulse. So this will be your last candlestick. You mark it out. You can see sniper entry, and then you write off your cells just like that. That's how it works. That's how supply and demand work. Before we move to the next part of the video, I wanted to quickly cut the confusion. So in the marketplace, consolidations are not always clean, right? Why am I saying so? Because right here, if you're not familiar with this, you will say that right here is not a consolidation phase, right here. You will say that the market reacted off this order block, which is wrong. Why am I saying so? Let me zoom in and show you. A consolidation phase is simply equal highs and equal lows, right? And the marketplace can't always print what? Can't always print equal highs and equal lows right the way you will spot them in the marketplace, right? So for example, right here, this order block was tapped, right? You can mark this low. This order block was tapped right here, and then the market rejected to the upside. But then note something, the market didn't break what? Didn't break this high right here. The market didn't break here. So if the market didn't break structure, but then it's still trading within what? This leg that created this order block, we can clearly say that the market is just consolidating, right? Until it expands to either one of the direction, either to the downside or the upside. So here the market expanded to the downside. So this is our break of structure to the downside, right? And then this is the order block that we're marking within that break of structure, within that consolidation phase. We don't actually mark the whole consolidation and take it as our supply. Finally, we on the part of the video where you will be learning how to correctly spot or draw your supply and demand zones. Your question says, where do we draw our zones, right? My answer is that once I identified my consolidation, what do I mark within it? And the answer is simple. I like to draw my zone of an indecision candlestick. So what is an indecision candlestick? I will go through the example in a few. An indecision candlestick is a candle where both buyers and sellers both come into power, which leaves us a candle with mainly wicks and small body. So it looks something like this, right? We have a small body and wicks on either side, right? We have small body and wicks on the sides. Where do we draw our zones? So before I answer that question, I want you to quickly look at these examples with me. So we have a bullish example and we also have a bearish example. So we have a rally, base, and a rally, right? So a rally simply means a rise in price, right? And then a base simply means what? Consolidation. And then we have a drop. A drop in a bearish manner. A drop, it's simply what? A fall in price. And then we have a base. A base simply means what? Consolidation, right? So now, if you see base, look at price with what? Premium and discount approach. So what does premium and discount mean? So simply anything in the world is what? It's supply and demand. So when the market is at demand, it seeks what? It seeks the buyers, right? And then when the market is at a premium, it seeks what? It seeks the sellers, right? So now you're gonna do what? You're gonna actually go for an extreme base. So an extreme consolidation. So in this manner, an extreme consolidation will be this one. This one right here, as we can see. And then price will continue. And then this consolidation right here will simply be resting liquidity there. It will be just inducement, which is liquidity resting there. If you went through if you went through the golden zones, you will understand this, right? So in a bearish manner, it's still the same thing. You're gonna go for what? For an extreme base. You're gonna go for an extreme base, and then just like that, right here will be our inducement, which is what? Liquidity. And then we can say simply, we can simply put it this way, our golden zone, right? Let's quickly check this example right here. We can already see that the market has done what? The market has done a consolidation right here, right? We can also include here, right? But then just to simplify it, let me just include this one, because we have 1, 2, 3 touches, right? So it's a nice what? It's a nice support, which keeps our consolidation very clean, right? And then we also have what? We also have consolidation right here. We also have consolidation right here. Remember what I said, we always go for the extreme consolidation, right? In this example, we are looking at a bullish example. So what or which order block will you mark between this one and this one? Because as we can see right here, you were gonna choose this one, and then just like that, and then you take this one as well. Which one will hold? Which one will hold? Let me include the full candlestick there. So which one is valid? The extreme one, right? The extreme one, because this one is just liquidity, because market makers already know that we're gonna place orders here, because we see what? We see a nice order block there after a break out of our consolidation. So understanding of premium and discount pricing is essential, because you will never be trapped in the market, right? But however, at some point, the market will only create what? One consolidation that will give us direction, right? For example, if you look at time frames like 4 hour, bigger time frames, you will notice that the market will only create what? One consolidation, and then rallies down, and then you're gonna enter off an order block that is given to you on that consolidation. For example, right here we have a consolidation right here. Right here we have our consolidation, and then when we zoom in, where is the last buy candlestick before the drop? Is this one, right? Because why am I saying is this one? Because it's the one that is responsible for what? For this drop right here that broke structure. Some people will say this one, which is incorrect, you see. So let's say after extending, I like to include this wick right here. After including it, and then I just enlarge it to the side. So as we can see, we had what? We had our break of structure to the downside out of what? Out of consolidation, right? And then the market came back to react at our order block that is left for us there, you see. So sometimes the market moves like this, you see. Sometimes the market doesn't always create double consolidations, because at some when the market is moving like this, already we can see where is our inducement. Our inducement is here. This is our golden zone, and we also have what we also have another liquidity here, right? And here also, you see, like these are building up liquidity. And then for some reasons it's simply what we call trend line liquidity. That one I was mentioning in market structure lesson, where I said that sometimes you'll come across what a resting liquidity. Resting liquidity simply means what simply means trend line liquidity and stuff like that. You see, just like that, we had our first touch, second touch, third touch, and the market broke to the downside. Yeah.